Good afternoon, ladies and gentlemen. Welcome to the September 2023 MiPlan Podcast. We're going to be covering the global macro environment as well as an update on performance of the global macro funds. And then we're going to really dig in a little bit in terms of the bond market's interpretation of the interest rate policy environment being set by the Fed, inflation expectations, and how financial markets have responded. We're also going to share with you why we have been more defensive in your portfolio since about June of this year and how we've changed the sector positioning. From a performance perspective, we're pleased to report that both the Dollar Global Fund in red and the South African Global Macro Fund in green have done well for the year to date. This is a chart that shows the performance post the launch of the Dollar Global Macro Fund relative to the global multi-asset flexible sector and a comfortable outperformance for the year to date. From a longer term perspective, a very nice record of global macro over 10 years now, sitting comfortably in first position with the 10-year track record and most other measurement periods post 5 years, roughly double the sector average. Looking at the current macro environment, it's really all about real yields and inflation. The Fed has highlighted that it is concerned that inflation is a little sticky. That is being driven largely by wage pressures, as well as shelter, energy prices, and certain other factors that have just caused the Fed to indicate that it will pause to see how inflation plays out in 2024 before it makes any decisions on lowering interest rates. Current expectations are for inflation to fall to about 3 and a bit percent in 2024, and that's still well above the Fed's target of 2%. In the very short term, supply constraints within the oil market has led to a rise in prices. In the top panel, you can see that crude oil inventories have declined as prices have risen, and in the lower panel, the strategic reserves have been run down, adding to supply constraints. We don't think that this is going to persist into 2024 as demand comes off, as growth slows, but for now it is an additional factor in central banks' considerations around interest rate policy. In focus at the Fed is the jobs market. It has softened, but it certainly hasn't softened by as much as the Fed would need to see in order for it to feel comfortable that wage pressures are abating. The layoffs in the tech sector happened quite quickly and early in the year. There was arguably a lot of excess employment within tech companies, and so they used the opportunity to trim their income statements and their costs a bit. But more recently, since June, you can see a slight sort of predominance of the green bars in the right-hand panel, but certainly nothing at a level that is going to move the needle on the unemployment rate. The US on average creates 250,000 jobs per month, so 71,000 jobs net loss since June isn't going to move the dial at all. A factor that we need to consider as we move into 2024 with regard to expectation around consumer expenditure is that savings rates, as you can see in the top panel, is slowing. And that's just a function of rising interest rates and the fact that many of the consumers have sort of passed their windfall spending post-COVID and are now setting into a more moderate pattern of consumer behavior. But the real chart in the pack is this one around real interest rates. We think that this is one of the key points of focus of the Fed. The Fed, post the 2008 global financial crisis, needed to re-establish real rates that had fallen into negative territory And by all accounts, we think Chairman Powell is reasonably comfortable with a current real yield of around 2% on the 10-year. How have financial markets responded? We would suggest the financial markets have reflected and are continuing to reflect this evolving macro picture. In the chart in front of you, the black line represents the 2-year Treasury, the grey line, the Fed fund rate. And you can see if you go back to the midpoint in 2021, how slow the Fed was to respond and how preemptive the 2-year Treasury was in forecasting the rise in not only nominal inflation, but the importance of the reestablishment of real yields. And so at this point in time, with 2-year Treasuries being a shade above 5% and the Fed funds rate being at 5.25%, we're reasonably comfortable that the market is voting that the Fed has done enough, and it simply needs to wait and give sufficient time for the higher Fed fund rate to work its way through the system in order to slow inflation. One of the reasons why we became more cautious on equity positioning in June was around the term premium argument. In very simple terms, term premium is the extra yield that you get for the inflation risk that you carry by investing in bonds that are maturing 10 years or further into the future. The current term premium, we would argue, is a little low, and we see the current rise in bond yields very much as a function of term premium adjustment. How high the yields will need to go is really a function of the market's interpretation of what that inflation risk premium is and the liquidity premium that comes in through all the funding that's currently being placed, funding pressure that's being placed on the US bond market. So it's a negative in the short term for equities. Equities have done reasonably well, very predictably. If you look at the vertical line on the chart in front of you, those are US inflation peaks over many cycles in the past. The median line to the right of the chart shows a median return post-inflation peak of around 9.93. S&P 500 is up about 13% year to date. And since the inflation peak, you can see that the dark black line has followed the median quite closely. The great predictions of a bear market, earnings collapse, recession risk, bottom right-hand panel of the chart does seem to have been overstated. Earnings have in fact not collapsed, and recession has all but been removed from the discussion around the global macro environment at the moment. We do think that there is a very reasonable possibility that 2024 sees something more than a soft landing, but that will be the subject of next month's podcast. What is concerning us at the moment is the concentration of performance in the S&P 500. The orange bars show you the return contribution from the top 10 stocks. The blue bars show you the contribution from the remaining 490. In a world of rising interest rates, particularly with the yield curve moving in a bear steepening fashion, we don't think that those returns are sustainable. Earnings itself and the earnings revisions have started to abate against a dollar index that has started to move higher. So whilst that provides a reasonably comfortable underpin for the remaining part of the year, we are concerned that the term premium on equities, as shown in this chart, is too low. Very simply put, if bond yields are rising and liquidity is becoming more constrained, equity risk premium should reward you for taking equity risk, not penalize you. This is almost a case of there was no alternative other than those top 10 stocks. And so the equity risk premium has risen to a level where, in our view, it no longer rewards the investor for the risk that's being taken relative to both a more constrained interest rate environment and liquidity environment. As a consequence, we have had a lot more cash, or we've held a lot more cash in the portfolio. We've been at about 27-28% in cash, 72-73% in equities, and on the right-hand panel we have moved a significant part of our technology exposure into more defensive positioning in financials, with the major exposure there being increases to companies like Visa, MasterCard, and the like, not the banks. The portfolio is far more defensively positioned at this point, and we just feel comfortable holding higher levels of cash until we start to get a clearer direction from the bond market that the term premium adjustment has completed its cycle. Thank you very much for your time.